So the first thing, which is extremely different from the traditional market and the cryptocurrency market, is the structure of the market themselves. So if you think about what a cryptocurrency market is, it's essentially two things. It's one large bank account and one large wallet. So a wallet, I mean, I guess you all know what it is, but it's like the equivalent of a bank account for bitcoins or for digital assets. So essentially, the exchange holds a bank account under their name, holds a wallet that they control, and clients send money to this bank account and to this wallet. So the funds are all stored by the exchange. They're doing all the balances. There's no third party involved. It's all done at the exchange level. So you have clients sending money, exchanging on the platform, and getting Bitcoin at some point. Now, when you look at the traditional markets, it's completely different. So the way a traditional market is structured, there's an exchange at the center, but the exchange is only doing one thing. It's taking orders from clients and matching them. There's no funds involved. An exchange will never hold any funds for their clients. It's only information transfer. So a trade gets done on the exchange. Now this trade needs to get settled. It needs to be tied with a money transfer. So you have on each side of the trade, you have bank accounts. Every client has a bank account, and you have brokerage accounts. So not necessarily digital assets, but for typical securities. So every client comes with their own account, their own security that they're holding themselves, and they're not giving it to the exchange. In between, you have clearing firms which are taking let's say, the execution risk by settling those trades. So if you look very quickly at the structure, you have something which is very different. You have an exchange which is basically an exchange, a clearing house, a custodian, so doing everything at the same time, holding the funds, matching your orders, and taking the risk, basically taking all the risk for the clients. In the traditional market, the exchange is not taking any financial risk for their clients. They're only matching orders. The clearing firm is taking care of the execution risk, and the custodians, whether it's a bank or a security custodian or whatever, is taking on the custody risk for their clients. So we have this risk controls, this risk which is split between different entities which are independent and don't work together. So that's really just, in terms of structure, it's not really the same, and this one has much less risk than the exchange.